The Fed raising rates by another 0.25%. Fed Chair Jerome Powell saying that inflation is still too hot and there is more work to be done to get it back down to that 2% target. While our next guest says that given the economic slowdown, ETFs can be a dynamic way for investors to reposition their portfolios. Let's talk about all that with Noel Archard, AllianceBernstein Global Head of ETFs. This is part of our ETF report brought to you by Invesco QQQ. Noel, it's great to have you here. So the first thing that investors need to keep in mind in the wake of this higher interest rate environment, some questions about uncertainty when it comes to a slowdown. What's the first thing that investors need to know when they're repositioning?
Well, I think obviously they need to think about what their time horizon is, what their individual portfolio needs are. I think a lot of investors have a fairly long-term time horizon. So there's a lot of uncertainty this year. Everyone said what was hoping for some clarity this year seems to have gotten a little bit more murky. So it's just thinking about all the normal things most of us think about. What's your risk profile? What kind of income generation are you looking for? How much volatility can you tolerate if there's uncertainty in moves? So a lot of portfolios can ride that out, but there's opportunities given the breadth of the ETF market today, the accessibility of that product, to make some decisions around where you want to be on the yield curve or what kind of dividend products you want, really what kind of risk protection you might want to put into a portfolio.
So active funds still make up a smaller portion of the vast size of the ETF market, right? But you are seeing more inflows into actively managed funds. What's your view on what you've seen there, and how should people be positioning themselves with regard to active versus passive? Because generally speaking, the view had been like, sure, you can try active, but really it's very hard to beat an index fund, a traditional index fund.
Yeah, we've seen a pretty significant I would almost call it an equalization happening in the marketplace over the last decades, really. If you think about sort of this long-term strategic asset allocation approach to investing has taken root, starting at the biggest institutions and has really spread out over the decades into retail investors. And this idea that you should really blend both the passive strategies and the active strategies can be pretty powerful, because in some situations, having the opportunity to change up what you're doing within a strategy can be really helpful. Again, I'll use dividends as an example. If there's changes to dividend policy within a company, does that mean it goes out of an index right away? Maybe that was just a bump. Should it have happened, not happened? We saw a lot of that in spring of 20. You look at what's happening with rates today and thinking about, do you want to take advantage of differentials in rates? That's a way that you could have a mainstream, a core position in an index fund. But we're seeing a lot of investors start to use the active ETFs, again, because of their accessibility, the tax efficiency, the efficiencies that the product brings, to put that next to some of their index investments to help take tactical tilts within their portfolio.
So do you think that this is a trend that's just going to continue, given the fact that it does sound like there is increased interest in active ETFs?
Yeah, absolutely. I mean, it's such early days. When we think about the ETF industry, it's $7 trillion in the U.S., which to me feels like this massive number. I've been involved in this for a long time, and it is quite a big number. But when you think about the scope of assets in the that are addressable, there's a lot of upside, and active ETFs are just pushing $400 billion now. A lot of that growth has happened in the last 2 years. Literally hundreds of new sponsors coming in to take their strategies and make them accessible via the ETF. So I think it is not even early innings. It's like the warm up at this point as far as how active ETFs are going to be moving into portfolios.
So I got to ask you, a day like today, we had an interest rate decision come down from the Fed. How should the average investor respond to a move like that? I mean, the average investor can't respond to every single economic event or economic data point that comes in. But today, the Fed is a big decision that comes down. What should the average investor do in response to that?
Yeah, the way that we're seeing investors use ETFs, especially in the active realm and the fixed income realm, fixed income, again, growth in bond ETFs has been really wonderful to see. And they're being used in the ways that sector ETFs were used, 5, 10 plus years ago, to say, I've got my core portfolio, but I have a conviction that this part of the market might have some more upside potential in the coming 6 months, 12 months, 3 years, whatever it might be. So when you look at what's going on in the rate, the Fed's been, today was really interesting. They went up. They seem to indicate that, there could be a pause coming, which is nice. But the market has been a little bit dare I say, stubborn, saying like, no, probably you want to lower them. I'm like, no, we're looking at 2. And they're like, no, but what if it's 3?
That's been the case for a while.
So it's like, what about 3? You're like, no, still looking for 2.
It's true.
So I think that the where you saw some investments even last month in the ETF market, we look at the flows, and you saw this shift from short duration into intermediate, into multi-sector, into high yield. I think as people are anticipating, okay, maybe we're getting to the end of the hike. I'm going to lock in some of these higher rates at this point. And that's fine. Like if that's a long-term investment, and you can take a little bit of movement still. If there's maybe a surprise hike, if there's some news that comes out that causes them to get concerned, if we see another spike of inflation, or if there's something else that causes it, you can then tilt your portfolio to the longer end of the curve. Or if you're still feeling, if you've got the opposite view, you can obviously tilt towards the shorter end and play a little bit more defense. So they're just versatility tools to put on tilts.
Noel, what can you tell us just about the recent conversations that you have had with your clients in terms of sentiment, given the fact that we have certainly seen so much volatility within just the banking sector over the last 6 weeks? Is that changing how investors are thinking about various opportunities?
Yeah, well, I think it's for most of them, it's these point in time issues. There's the concerns in the regional banks that we just went through. That's created, tightening within the credit space. There's obviously concern about recessions, but then, a slowdown in growth. But then we had a fairly robust earnings, week of earnings over the past week. Jobs are softening, but not to the degree, again, that Chairman Powell was sitting up there saying, we're backing off. So I think where most people are looking is stepping back and saying, can we take a view that stretches out 2 or 3 years? If so, then there's a lot of opportunities in where the market is today to actually take advantage of that growth cycle, because we usually see when you get past these rough patches, you hit the next acceleration point, and it's nice to buy into that dip.